Welcome everyone to our March 29th, 2012 SR&ED Changes Summary. My name is Dave Sabina and I'm hosting the presentation. Now the 2012 budget had anticipated some fairly major changes. However, they were relatively small this year in relation to what was expected. There was 4 specific changes which we're going to talk about very quickly. And the balance of the presentation will talk about issues that we anticipate being introduced into budgets perhaps in 2013 or 2014. So the first of the current changes relate to the federal ITC rate for non-CCPCs, the large companies, public or foreign-owned. And effectively, the ITC rate is going to go from 20% to 15% effective 2004, and all of these changes will be prorated for short taxation years. With respect to subcontractor costs, which are 100% eligible, or 100% of subcontractor costs are eligible for tax credits right now, that will be reduced to 80% starting calendar 2013 and onwards. This is similar in many ways to the Quebec tax credit system, which deems 50% of a contractor's cost to be labor, and they base it on labor. So again, some allocation of the contractor cost to the estimated percentage of what should be eligible SR&ED within that on an average. Number 3 is to phase out the 65% rate to calculate the proxy amount, which is a multiplication of the salary base, which roughly equates to the R&D wages that a company is claiming. And that will be phased out from 65% to 55% over the next 3 years. The last major change is effective for calendar 2014 onwards, which is to the elimination of any tax credits on capital. One of the issues that there was some confusion on in the last day or so is whether the reduction of the tax credit of the 20 to 15% applied to all taxpayers, or whether it was really the non-CCPCs. So in the Annex 4 of the budget documents, they clarified that the rate applicable to CCPCs on the first $3 million of qualified expenditures will remain at 35%, but after that amount, again, it will be reduced to 15% instead of 20%. For large companies, the effective rate will be reduced to 20%, as well as all non-qualified CCPCs. Getting on to the issues that weren't addressed directly in the 2012 budget, but which many people assume, or we assume, are going to be addressed in 2013 plus budgets, are summarized in the remaining slides. As background to these issues, the government commissioned a report called the Jenkins Expert Panel by practitioners. It was actually called Innovation Canada Call to Action. It was released in October 2011. It's approximately 150 pages. There were additional reports by private industry and academia, the Mowat Center at U of T, the C.D. Howe Institute, and by a consortium between CATA, the Canadian Advanced Technology Association, and one of their spokesperson or directors, Sir Terry Matthews. These various reports are going to be referred to in the rest of the presentation. Some of the common recommendations were to consider, in many reports, moving some tax credits to other kinds of science and technology support. We'll talk about that further. To provide partial refundability of tax credits to all claimants, particularly large and foreign companies. To potentially simplify the calculations by focusing on labor as opposed to materials, contractors, and capital, or within the contractor cost to deem a smaller portion of that to be labor, which in fact we've seen in the pronouncements. And one group in particular, CATA, introduced a new concept, which is reducing the filing deadline from 18 months to 6 months, which will bring claims up more current. Some of the other non-SR&ED tax credit issues that were addressed in those reports were providing new funds for commercialization, promotion of clustering into 4 sectors and additional funds to those sectors, promoting more industry government direction, and talking about government purchasing and immigration priorities to facilitate both bringing in skilled scientists and engineers to Canada and quickly accrediting them or recognizing accreditations from other jurisdictions to allow them to practice sooner. The federal government provided some background papers on science and technology through Industry Canada, which we can assume are going to be correlated with the recommendations that they're going to make on the SR&ED and all other S&T funding. These papers, published in 2007 and 2009, outline three main objectives and related principles to deploy them. The objectives themselves talk about entrepreneurial advantage, which talks about removing high tax rates or reducing tax rates, as well as providing specific funding by sectors and supporting research and commercialization centers. They also talk about focusing on clusters, enhancing immigration, and reducing personal income tax. So all of those various methods we've actually seen instituted over the last 4 to 5 years. They also provide some additional principles for administering any funding, including accountability, promoting competition, looking at priorities, which will assume mean strategic clusters, and promoting partnerships between business and academia, and also large and small business at home and abroad. So in our recommendations, we're going to try to address those issues. As background to some of the public issues or the concerns that have been raised by taxpayers and the public in general, we're going to use a series of articles released by the Globe and Mail starting March 2011 and continuing really through to 2012. The first three of these articles raise some of the major issues of concern which we believe are going to be addressed not only in the current budget but in the 2013 and onwards. The first is the issue of the percentage of costs paid to consultants, and a misassumption, I think, that a high proportion of the SR&ED credits are actually being pocketed by accountants or consultants for related services. The next is an issue of the public's perception of the benefits of every dollar that the government puts in to the SR&ED system and the related benefits on the flip side to the economy. There's also issue 3 being confusion of which areas of science deserve the funding. A fourth issue of whether the Canada Revenue Agency is the optimal agency to administer this funding. And some discussion of alternatives to the refundable credits. There's various follow-up articles that compare the funding versus grants, that talk about the clustering issues or strategic issues further, whether we should focus on specific areas of technology or industries, and discussion of providing more money to venture capital, which they assume will provide more commercialization. To address all these various issues, we've prioritized them and listed them in 6 key issues and circulated a questionnaire to practitioners, claimants, and what we call SR&ED stakeholders. Many of these companies were clients who claimed both grants and tax credits under the system, so strong SR&ED performers, and we weighed their opinions in along with both accountants and other people in the SR&ED stakeholder system. The first main issue was whether we should refund investment tax credits to large companies and foreign companies, and whether it's a full or partial refund of the 20% credit that they currently earn. The large majority of respondents actually agreed that this was a good idea. Whether it should be full or partial was an issue of concern, and how the government would deploy it were also areas of considerable discussion, which we'll address later in this presentation. The next issue was whether the government should focus on strategic clusters. And there seemed to be a lot of ambivalence from respondents on that most felt unqualified to comment on it, and that the majority of respondents who had an opinion, it tended to be related to their industry and whether they were favored or not. With respect to restricting eligible cost of labor only versus material and capital, this and a few other issues were highly debated amongst respondents, and the initial responses, when we were given the opportunity to discuss the issues further, often shifted. So 40% of respondents initially agreed that it was a great idea to shift, or disagreed that it was a good idea to shift any credits from materials and capital to labor. But on further discussion or resupposition of the issue on if something had to be cut, would you rather cut labor, materials, or capital, the vast majority of stakeholders agreed that labor was probably the primary and obvious choice as the base for the incentive. The fourth main issue is shifting funding from tax credits to grants, contracts, or other kinds of venture capital funding. The vast majority of respondents disagreed with that, and the most interesting responses were from claimants who claim both IRAP, which would be the grant program, small and medium-sized companies, and the SR&ED program. And the majority of them, though they liked them both, felt very strongly that if a cut had to come to one of those, they would leave the SR&ED program as it is and consider reducing the IRAP or the direct grant program. With respect to issue 5, the reduction of the filing deadline from 6 to 18 months, again, when initially posed, approximately 60% of respondents were in agreement, but on the issue of further that we'll discuss further, it actually climbed to closer to 90% agreement with a full appreciation of the facts. The last of the major issues we discussed was whether the CRA should continue to administer the technological eligibility of the program, or whether they should use some new National Research Council-based agency or another type of agency. And approximately 80% of respondents agreed that the CRA was the best administrator of the program. We'll discuss some of the reasons later on in the presentation. In response to the first 6 issues, we also asked people what some of the recommendations could be. So with respect to the commercialization idea and the refundability of ITCs to large companies, perhaps that should be tied to collaboration with smaller, what we call smaller medium-sized enterprises, SMEs, or CCPCs within the Income Tax Act. And the vast majority of respondents and stakeholders agreed with that position. The other key issue, which ties back to the grants versus funding, is to really understand why industry prefers the SR&ED system overwhelmingly to the grant system before making any significant shifts. The 6 issues in question were actually presented by our R&D-based SR&ED consortium to the MP for the Burlington area, Mr. Mike Wallace, in relation to the questionnaire outlined above. It also addressed issues on recommendations that the CRA could take into account for both streamlining their administration on technological eligibility as well as the financial complexity of claims. So the detailed discussion on each of these issues focused on the key points. The first of these issues, the refundability of ITCs to large corporations, looked at how much R&D is moving outside of Canada due to the ability of these large companies to use non-refundable credits. We talked about maybe making these credits all or partially refundable, and the current budget's actually reducing them from a 20% to a 15% rate. If part of those credits were in fact refundable, that would encourage the work to stay in Canada. Better yet, if those credits were enhanced or refundable on a basis of collaborating with smaller, medium-sized Canadian enterprises, it also meets the government's objectives in helping those companies grow in commercialization and knowledge transfer. As a quick overview to understand how much of the government's resources or tax revenues are being distributed to each of these groups, large and small, we look at the latest metrics, which were published for 2004. So of the 3.3 billion roughly that was handed out by the federal government in the 2004 taxation year, over two-thirds of it, 2.2 billion, went to the roughly 4,000 large or foreign-controlled companies that earn tax credits at a 20% rate. The remaining $1 billion, or slightly less than one-third of that funding, went to the roughly 16,000 small and medium-sized companies that earn tax credit at a 35% rate. So when implications are talking about large and small companies, the large companies and foreign-controlled companies, or those earning at a 20% rate, are the large majority of claimants now, but there seems to be a considerable opportunity to leverage the value of their knowledge and commercialization to partner with the smaller clients. The second major issue was on concentrating funds on new strategic clusters and whether the government should do this. This issue was met, as we said, with relative ambivalence by the group, but we thought we'd briefly outline the clusters that are likely to receive direct grant or other kinds of funding in current and future budgets. The priorities identified in the 2007 and 2009 Industry Canada reports identify the top 4 industries as environmental sciences, natural resources, health and life sciences, as well as information and communication technologies. Other areas that are identified for potential funding or strategic support include the auto sector, life sciences, banking, and supported IT and communications. The third main issue was restricting the eligible cost to labor versus materials. Some of the major advantages that were cited was, one, that Quebec had effectively used this for decades. Secondly, that the CRA can very quickly review payroll records without having to do on-site visits, since they have all the payroll withholdings. And probably the primary issue is that this is a hedged transaction. In other words, the only way for a claimant to earn more tax credits is to pay more Canadian wages, which then funds the system by the payment of Canadian income taxes. On the flip side, payment of credits for materials or capital, which can be sourced abroad, don't necessarily create any tax revenue for the Canadian tax system and could ultimately bankrupt the program if overfunded. One of the cons identified by respondents to the claim was that the CRA still has a lot of problems on tracking time and providing clear direction on what an adequate timesheet or reporting system would be within the program. The fourth major issue was on shift of funding from SR&ED to grants, contracts, or venture capital. And the recommendations were to understand why industry shows a great preference of the SR&ED, what they call the indirect funding or tax credits, over the grants or direct funding. Our estimates are that there's approximately 25,000 claimants for SR&ED each year, and less than 5,000 to 2,500 at most IRAP claimants or direct funding claimants. Worse yet, less than 1,000 deals on average get funded by venture capital in Canada, and venture capitalists tend to require a larger return on investment. Our prior newsletters provide a quick overview of some of the comparative pros and cons of grants, direct funding, that they can be aimed at specific areas or regions to provide a higher social rate of return, and that they can be budgeted to the dollar, versus tax credits, which are more of a right of the taxpayer if they choose to do investment in that area. Some of the arguments for the credits are that they're neutral, that it allows business to choose the investments, avoids having the government choose winners. It's more predictable for business. It will therefore get a wider reach of claimants and industries. The administrative costs, if handled properly, can be low, and it's more accessible to the average claimant. Probably one of the main issues is that under free trade agreements and NAFTA, the fiscal tax credits are neutral because they're available to all taxpayers, whereas direct grants and funding tends to be a violation of those treaties, again, so creating more problems for international trade. Probably one of the most important things to understand when looking at Globe and Mail articles or comparisons of Canadian performance and funding versus other countries is the scope of the net investment that the Canadian government makes versus the performance of the related Canadian corporations. There's a lot of talk in the Globe and Mail and other publications that the Canadian performance is on par or perhaps even subpar with the United States, which provides most of its funding via the direct system, either government contracts or grants. And the important thing in this scope is to look at an OECD study from 2001 that compares the funding of various countries. Admittedly, the United States provides less in tax credits, what they call indirect funding, than Canada, but ultimately they fund 12% or 12 cents of every dollar of expenditures by business on research and development is financed by the U.S. government, whereas the Canadian government finances roughly 4%. The ultimate conclusion that you can make from this chart is that though the U.S. government funds 300% the amount of SR&ED per capita, the ultimate performance of those incentives is roughly equal in that the Canadian company's performance is slightly less than the U.S., but at 1/3 the investment. It was also noted by many people in the industry that the big shift seems to be other countries moving from the direct grants to the tax credit system. So a lot of people really challenge the idea that Canada should in turn go the opposite way and move from the tax credit system to the grants, when all indicators seem to be that the tax credit system greatly outperforms the grant system. With the issue of contracts or procurement of government resources, one issue I like to cite was that of the Corel chairman, Michael Copeland, who cited that the government of Canada failed to back Corel Office and buy it for its employees and instead used Microsoft Office, a U.S. firm. This would have been a great example of a failure for the government to recognize the strategic potential of investing in small companies, SR&ED intensive particularly, for the purposes of creating an ongoing and nurturing an ongoing area where they can expand and build a base. This would be probably one of the greatest failures, I'd say, that I can think of in recent decades, and perhaps the new legislation or proposals will take that into account. With respect to venture capital, again, putting too much money into this could be a bit of a misnomer or going in the wrong direction, because there's relatively few deals being done a year. The demand of an average venture capitalist is a minimum 40% return on investment forever on a one-time investment. So again, it puts a high strain on the companies. We're talking about funding of less than 1,000 companies a year via venture capital, and those are one-time investments versus 25,000 companies a year plus on the SR&ED system, which are every year investments. So again, shifting money from the SR&ED system to a venture capital system may put ourselves under a strategy of putting all the eggs into very few baskets. It was also noted in various reports that most of the economies that are thriving right now, including India and China, have a relatively low proportion of venture capital compared to Canada and especially the United States. So arguments that we should follow the U.S. model as opposed to these other models are also being challenged. The fifth major issue on reducing filing deadlines from 6 to 18 months is cited by CATA on an estimate that approximately 30% of CRA cost of compliance are related to these amended claims. Talking to many practitioners, they're also indicative of clients who haven't kept proper records and as a result are unable to prepare the documents within 6 months of year end. Many people feel that these types of claims are not indicative of the objectives of the system, and that if significant CRA cost savings could be made in that area, that would be an area that the government should consider seriously. When claimants were first posed with the issue on restriction of the filing deadline, many felt that it was uh, a bad idea until we discussed the facts on the prior slide. When posed differently and said, if we had to cut some cost or some area of the system, which of those areas would you most likely pick? This was an overwhelming favorite. So I think that opinions on this, although originally in opposition, appear to be able to shift when considering the big picture of overall SR&ED funding. The sixth and last of the main issues was on using the CRA versus a new agency for technology eligibility. As previously mentioned, most people ultimately favored use of the CRA because it provides a system to object through the tax courts, which has precedents built literally hundreds of years. There's no similar rights or objectivity under any grants programs, and there's no similar accountability as well. Many people feel that the grant programs, again, are in violation of international treaties and agreements on free trade, and that they've been are subject to considerable corruption. Many people have cited how even former prime ministers are generally being charged or insinuated in conspiracies to misallocate these types of funds, whereas the funds under the Income Tax Act have a far lower risk of such misappropriation. Just to cite now some of the issues that are being commented on in newspapers or in public opinions. One is what they call the net benefit or payback of every dollar the government invests. The term that's used is marginal utility, and the Globe and Mail, as we mentioned, talks about various reports, international reports, over the decades that cite that for every dollar invested, the elasticity or marginal utility of that credit is roughly break even, or a 1-to-1 ratio. And that part of the puzzle is true, but the big picture is that when you start with this 1-to-1 payback, economists agree that the overall payback for every dollar invested in R&D is roughly 6 to 8 times that 1-to-1 payback, or $6 to $8 for every dollar invested by the government in the tax credit system. The second major issue that's not addressed in here but seems as an issue of potential collaboration versus confrontation is that the U.S. continues to expand its SR&ED tax credit, or research and development tax credit. Despite the fact that it does this federally, certain states, including the governor of Michigan, have begun questioning the fairness of business tax breaks, claiming that Canada should consider getting rid of tax credits, as the government of Michigan is intending to do. So this seems like a bit of a dichotomy between the states and the federal government, but nevertheless, any company performing research in Michigan would still qualify for the federal credits. It seems that the biggest problem down there is that there's very few practitioners or IRS agents who understand the system, and therefore small and medium-sized clients can't claim. I think that there's a huge opportunity for not only cooperation and collaboration between Canadian and U.S. companies, which is already occurring on a large scale day to day, but for the IRS and the CRA to recognize that and to contemplate a joint SR&ED tax credit claim. One of the third issues that's been talked about recently is regulation of fees for consultants to support clients in the SR&ED tax credit system. This has actually been implemented in the US and in Canadian systems such as IRAP or NRC, where they don't use consultants at all and they use their own staff. Some of the other ideas or proposals are perhaps to simplify the system instead, make it easier for claimants to understand, and then allow the free market to provide the service and level of fees that the market expects. The issue became hot on a March 7th comment in the Globe and Mail by the Minister of Science and Technology, saying that he's not concerned about what accountants charge for everyday work, but if the fees are becoming exorbitant, he feels that they may be being siphoned from the sectors that they're desired, science and technology, into other areas of the economy. The Globe and Mail article also cited comments of a managing partner of Deloitte's, who cited a further CICA report from the Institute of Chartered Accountants that the top 6 accounting firms in Canada earned $117 million in 2010 from SR&ED. If we extrapolate that back to our prior slide, saying that they probably represent a vast majority of the large clients and foreign clients, they claim that 2/3 of the tax credits, it looks like the cost of compliance of large companies would be less than 2%. He also proposes that the government could root out overly aggressive practices by banning contingency fees and requiring registration of all consultants. Having talked to consultants on that, and with my own personal experience, I offer clients the opportunity to pay hourly, flat fee, or contingency fee, and find that many, particularly in the first year, and small and medium-sized clients, with uncertainty as to the success of their claim, prefer the contingency fee route, and ultimately may switch, once successful, to another method of billing. I think it's in both the government and the claimant's interest that the government allow the business owner to pick the method that he or she feels is best suited to their business and conduct of their business, as opposed to regulating or trying to provide further regulation on how that's conducted. A 1990s report illustrates part of the issue, which seems to be that the smaller firms who claim under 200,000 of credits a year have a higher cost of compliance. On average, the mean up to 30%. However, the vast majority of claims, as we've illustrated previously, are in the $1 million plus range, and generally speaking, the cost of compliance is under 2%. With issues on CRA administration of the program and areas for potential improvement, a report was issued in December 2011 called the CRA Ombudsman Report. It was the result of a series of questions and responses that were collected back in 2007 onwards. The result of this collection and ongoing survey was that the Ombudsman reported they did not receive any complaints they could substantiate. However, they recognized inconsistencies on how the program is administered. One of the examples they provided was that certain research and technology advisors stated a claim did not meet the criteria of the Income Tax Act without providing adequate information, and that those practices were likely suspect and should be improved. Regrettably, part of this study was started with a basis of 5 major questions from claimants and preparers, and are related to post-February 21st, 2007 SR&ED claims. A lot of them asked about understanding of the changes, requests for second opinions, and whether any CRA personnel had tried to dissuade claimants from using professional advice, an issue that's still popular. Sadly, the report itself made no mention of any comments or responses on any of these issues. One of the recommendations or responses that practitioners and stakeholders are contemplating now is, rather than responding to the Ombudsman, which appears to have a degree of secrecy, that more complaints should be made public and discussed in the public forum to remove the secretive nature of this process. This might provide the accountability required, and do this using specific facts that can be used to further train claimants. With respect to issues on CRA administrating technology eligibility and financial eligibility, we have additional recommendations from the group. Before we go into those recommendations, we try to look at things from the CRA point of view. In January 2012, the Director General of the program, Ms. Betts, provided a list of the 5 key complaints of industry towards the CRA and the 5 key complaints of the CRA towards claimants. From industry, the #1 complaint was that they felt certain research and technology advisors were not qualified to correctly assess the claims. As a result, they felt there was narrowing of eligibility criteria, that the forms and process were needlessly complex, that the resulting documentation that was being required was too onerous, and the result was that the outcomes were uncertain from year to year, and that business really required a degree of consistency to invest in any long-term program. From the CRA's perspective, their number one complaint was personal attacks against CRA staff. A close secondary complaint was that the claimants were providing an inadequate amount of information to allow the CRA to assess their claims from a desk review. They also mentioned that success fee billings may be onerous or unfairly diverting benefits to consultants, which is not the intention of the program. And as a result, the claims are becoming increasingly aggressive to the point where they're being withdrawn when challenged. This has become a problem in certain areas to the point where the CRA said that the claims were so abusive and so prevalent that they may include pursuing penalties against not only the claimant but the practitioners that filed it. Some of the recommendations we have as a result on technology eligibility are: number one, to develop at least one complete project example by industry. The CRA cited that they have over 120 published examples, but we would propose that not one of them meets the CRA required submission standards, and that rather providing a plethora of incomplete examples, claimants would be better served with one complete example illustrating the technical documentation, as well as supporting examples of supporting documentation, as well as financial documentation, including adequate timesheet documentation or records. A second major opportunity would be to be able to provide some kind of third-party second review system to arbitrate and settle disputes within a reasonable amount of time. Most claimants felt that it was in their interest to have the disputes settled even if it was not in their favor, and to be able to move on with business rather than to have claims dragging on for months and in some cases years where certain issues could not be settled. Ultimately, we feel the core problem here is an inability for the CRA to clearly describe what they're looking for with respect to the criteria of technological advancement. We basically feel that there's three major components to this system, but they contain certain subcomponents. And that if practitioners or claimants either fail to benchmark standard practice, to quantify objectives, to break their uncertainties into the actual variables that create the system uncertainty and illustrate the understanding of the science behind the problem, if they fail to list the number of experiments or alternatives and the method that they used, whether it was analysis, which could be fairly quick, whether it was actual physical trials, which tend to take longer, or whether it was the construction of complete prototypes, which tends to take the longest, then the CRA would not be able to desk review the claims. Lastly, there was often a tendency to focus on just results in relation to objectives, which is a good preamble to the conclusions themselves. But that ultimately the conclusions need to be tied back to the variables of technological uncertainty to illustrate the new understanding of the technology that was achieved. Ultimately, when we feel clients are provided with this framework, they're more than capable of self-assessing claims relatively quickly. A quick example would be using the case of Gentel, where a taxpayer had a patented technology yet lost their SR&ED claim in court. Much of it was due to the fact that they provided general information without specific backup. What the CRA could do is take these opportunities to rather than discourage taxpayers, provide a list of positive or negative indicators on what the taxpayer likely did versus what the taxpayer might have done or illustrated in order to show eligibility. On the financial side, we believe there's a lot of merit in focusing more and more on wages, whether it be direct or via subcontractor. This model has been used effectively in Quebec. It provides a simplified calculation in many ways in the fact that the CRA can quickly review the payroll numbers by employee and isolate any variances before doing a site visit. On the flip side, one of the big complaints is from claimants and the CRA is a misunderstanding or an inability to understand what adequate time records mean and time reporting. So in relation to the simplified calculations, I think there's an opportunity here to increase compliance with adequate direction on time reporting and related documentation. This in turn will mitigate a lot of the risk to consultants who have to face lawsuits on potential damages for incomplete claims, failure to contemplate things like future tax consequences, inability to bonus down once income is too high, and the fact that many complications are calculated and open to misinterpretation. To wrap up the presentation, some of the other issues within the science and technology budget that have recently come to pass are on the commercialization of the research and technology performed either under SR&ED or the grants. We feel one of the great areas of cooperation or collaboration could be with the T661 or the SR&ED claim description themselves, that both small and large companies as well as Canadian and international companies could use a joint description for multiple claims. This would allow an opportunity for Canada-US trade and research, as well as an opportunity for the IRS to expand its own abilities to review these claims and build a base of practitioners in the US so that these claims could be jointly administered by the CRA and the IRS and claims made jointly by Canadian and US claimants. The infrastructure to accomplish such a task is already inherent in the Canadian form, where for each project, lines 218 to 221, ask if any work was done with other businesses, the name of the business, and the Canadian business number, or in the case of the IRS, their filing identification number. Another great idea that's recently emerged from the US, or potentially a great idea, is a model called crowdfunding. The formal name is the U.S. Entrepreneurs and Access to Capital Act, which has recently been passed in the House by overwhelming majority and is currently in the Senate. In Canada, various groups, including CATA, have found that it's a good model and is being recommended. They've likened it to a bake sale where small companies can make pitches to small investors for large amounts of money to get projects off the ground. In the U.S. legislation, they're contemplating a limit of funding that can be raised to $1 million a year, $2 million if a company can provide audited financial statements. And on the flip side, to protect investors, it limits any investment to the lesser of $10,000 and 10% of the investor's annual income to avoid people without the means losing money on what's seen to be a relatively high-risk investment. On discussion with other stakeholders, most parties appear to agree that this is a promising incentive for small companies to raise private capital, not only for the development, but ultimately the commercialization. And very importantly, it doesn't require the use of taxpayer funds. So it seems to get general acceptance as long as we can protect the investor from frauds or misappropriation of funds. That concludes our presentation. Any questions or issues, we welcome your direct contact. You can email me, the presenter, Dave Sabina, at dsabina, dsabina, @meuk.net. I hope you have a great weekend.